All right, everybody, welcome to this second segment of the Trading 101 that I put together for you guys. Today, the topic we're going to be going over will be trading with moving averages. Now, as a reminder, this is how I personally trade. This isn't necessarily the right way to trade. So just take this as something that I'm, giving to you guys. I'm just showing you guys how I trade. You can take it as you will. So let's get started here. So with moving averages, there are different types of moving averages. These are the two main types of moving averages that I personally use. They're going to be the simple moving average, or the SMA, and the exponential moving average, that's the EMA. So moving averages, in simpler terms, is basically just a moving average. It's consisted of the average of the closing price of the selected time period. So as an example, if you have the 50 SMA, or the 50 simple moving average on your chart, that is basically the average of the closing price of the last 50 days. So a lot of people don't understand what the difference is. The difference is the exponential moving average is basically a weighted moving average. So it basically just moves quicker and it moves more with price action. Now, as a reminder, moving averages are lagging indicators, meaning they move after price moves. So you really cannot predict a move solely based off of a moving average. So price moves, and because of the move that price action just made, that's what makes the moving averages move. So there are different ways that you can use moving averages. The main ways that I use them is trend identification. So if you guys look at my chart right here, as a broad perspective, you can think of it as if the lower moving average is above your higher moving average. So if you look at my chart right here, this blue line would be my 9 exponential moving average, and the green line is the 21 exponential moving average. So the lower EMA, which is the 9, which is the blue line, if it's above the green line, which is 21, or the higher moving average, that would signify an uptrend. If it's below it, like you see here, the 9 is below the 21, that would be a downtrend. Now, it's not solely based off of that. This isn't just set in stone. It's not, right all the time, but just as a broad perspective, that's how you could look at these trends. So you see here, 9 EMA is above your 21, and you have a nice uptrend. Once you get a moving average crossover, right down here, you have your 21 above your 9 EMA right here, then that is a downtrend. Another way you could use moving averages is with reversals. So when I mentioned the moving average crossover up here, once the 9 moving average cross below the 21 moving average, that could be signaled a reversal, and your uptrend is now starting to be a downtrend. Another one would be consolidation. So with consolidation, if you look, let me get a good example right down here. When your moving averages are really, really tight, when they're really close together, that could signify some consolidation. So once they're broken apart like this, that's a strong trend. And another way of using it would be an active support and resistance. So like I said, moving averages are always moving. They move with price action. So you could use these as a type of support and resistance. So if you can see down here, when we had our downtrend start, price comes up and tests the 21 moving average and rejects. Tests it again and rejects. Tests it again and rejects. So you could use this as a type of support and resistance. So if you have a candle closure above the 21 moving average, like you have right here, this could be a signal or a type of confirmation to tell you to exit a trade, stuff like that. Now, it's not going to work every time. We all get shaken out. There's always false breakouts, false reversals, stuff like that. So just be mindful of other types of confirmation when you're using moving averages. So going back to the crosses, there are names for them, which is the golden and the death cross. A golden cross is when your short-term moving average crosses over a longer-term moving average. So for an example, if your 50 SMA crosses above your 200 SMA, that would signify a golden cross. Golden cross is a bullish sentiment. So if you say right here, your 50 is crossing above your 200, the 50 is the yellow dotted line, the 200 is the red dotted line. Once you have a crossover above, it has a strong uptrend. And like I said before, you can use this as an active support and resistance. You have price coming back down, testing this 50 simple moving average, and bouncing off and continuing the uptrend. Once it does cross below, you have a strong candle closure below with high volume, then that starts a downtrend. With a death cross, it's basically just the opposite. Your shorter term moving average trends, or it crosses below your higher long-term moving average. So I like to use this example for the exponential moving averages just because they move quicker with price action. So like I said before, once your 9 EMA crosses below your 21 EMA, that could signify a death cross. And a lot of people like to use it with the simple moving average just because it moves slower with price action, so it will hold more value, especially on higher time frames. So when you guys are looking for these golden crosses and death crosses, moving average crossovers, stuff like that, always look for high volume. Whenever you have a move like this, whenever you have a crossover, look for high volume. Look for that significance with the buyers or sellers pushing the price in that direction. The more volume that you have, the higher confirmation that you have, the bigger the move will be. All right, so a lot of people always ask me what moving averages I use, what indicators do I use. These are a list of the ones I use. We also have a list of the other moving averages and indicators that other staff use. If you guys want to see that, it's up in the fact channel in the Discord server. You guys can take a look at that if you want to. But remember, every trader will have a different style. There's not a set perfect moving average that you guys can use. There's not two of them that work, perfectly together. You just have to test out different things, see what works best for your style of trading. Always experiment, see what works better for you, and then, play it by ear like that. I really suggest practicing on a paper trading account, or you can use the on-demand feature on Thinkorswim with TD Ameritrade. That would be your best bet to practice or test different strategies without risking any capital. So if you choose to use moving averages, remember that is only one form of confirmation. The more confirmation, the higher probability that your trade will be profitable. So like I said before, you do not want to have your moving averages as your sole base of getting into a trade, getting out of a trade. You want to have a lot of forms of confirmation to back up your decision on your play. The more confirmation that you have, like I said, the better or the more probable your trade will be profitable. So I want to come back here to my chart just to give you guys some examples of how I would trade with moving averages. So coming back to this consolidation area right here, a consolidation area is a nice way to see where price is going to go. You see this consolidation, you have your moving averages really tight. So what you want to look for is a strong move, a strong candle with high volume. So you have all this consolidation here, your moving averages are really, really tight, and all you're waiting for is a strong break with high volume. So if you can see right here, this big gap that you have right here, this is probably after hours. You have this huge gap above your moving averages, but there's no volume. So like I said, this is after hours, so you want to, pay attention to volume. Right when market opens back up, you have a high volume and they come right back below the moving average. So this is just pure consolidation. So all you're waiting for is a strong break. You have all these wicks coming up. Remember, I do not consider anything to break unless you have a candle closure above your whatever you're looking at. It could be a support resistance, it could be a moving average, it could be a chart pattern, stuff like that. So that's all I'm looking for. So right when I see a strong move above my moving averages up here, you have really high volume with this strong Marubozu candle right here, and then you have your moving average crossover. This would be a nice form of confirmation to enter this trade. You have your moving average crossover, you have a strong candle with a very high volume. You can see this volume bar is ending right here, and that is the highest it's been in the last couple of sessions for this stock right now. So that's a really, really high move. It crossed over both moving averages, your 9 and your 21 EMA. It also crossed above your 50 SMA. So that is a really strong confirmation for this trade to be profitable. So this is where I ended my trade. Go back down to my other indicators. You have your TTM squeeze breaking out of or firing out of a squeeze to the upside. You have both MACDs turning up, upward momentum. So that is a really strong trade with a lot of confirmation behind this trade. So that would be the highest probable trade to be profitable. And then if you're looking at it, what do you use your moving average as? A form of support and resistance. You have, your 9 and 21. I love to use my 21 EMA to basically be some form of stop loss. If price gets below, if it closes below my 21 EMA, that would signify, either take profit or cut my losses, stuff like that. So you have this really strong uptrend coming. Price comes back down to 9 EMA, bounces off, breaks below 90 EMA, but it does bounce right off the 21 EMA and continues the uptrend. So honestly, if you were looking at this, if you got into the trade on the 2-hour time frame like I'm showing here, and you're only looking at the 2-hour time frame to take your profit, and if you're just solely basing off of price action, you could say, okay, the moment I take profit is when, or cut my losses, is when price cuts below the 21 EMA. So you could have caught this whole move right here. And then right when price crosses below, this is where you take your profit. So you caught this whole move up here. Anybody have any questions with moving averages? That was basically just the class, guys. It wasn't anything, too crazy. It's actually really simple. I do recommend you guys play around with it a little bit, test different theories. Go ahead, go up to the fact channel and see what other indicators, what other moving averages other staff uses, implement that into your guys' charts and just practice with them. One thing I do recommend though is not to have too many moving averages on your guys' charts. With me, when I trade intraday, I only have my 9, my 21 EMA, and my VWAP on my charts, and that is it. When I'm doing technical analysis, that's when I'll throw in my 50 and 200 simple moving average on those charts just to get the higher, just get more value out of where price is going, certain big rejection points, support zones, stuff like that. Does anybody have any questions about that? Does anybody want me to go like that or anything that I previously mentioned in the class? No? Okay, cool. So that was basically it, guys. As always, if suggestions that you want me to show in the next class, if you guys have anything that you want to see in a future class, go ahead. You could DM me or you could throw it in the suggestion channel in the Discord. That's basically it, guys. Enjoy your weekend, and thank you so much for joining me.